I hope people can see me and hear me. Okay, great. Sorry, we are having some connection problems. Hopefully, we will solve it in a minute. Um, Great, thank you very much. I'm just getting in through uh, some other link, so that's hopefully that will work. Um, just give me a little bit of time to set myself up to see if everything is all right. Yeah, just give me a second, please. Okay. Sorry, I apologize. We have some linking issues here, so I'm just using another another device, and I'm not sure whether this device will work very well with the PowerPoint slides. We'll try and manage as much as possible. So let's start off because we're already 10 minutes into the session, so I don't want to waste people's time. It's already 7 o'clock. So first of all, thank you all very much for coming here at this time. Just give me 1 second. Let me just get myself sorted. Thank you very much for coming at the short notice to this session. We usually have our session on Saturdays, but because we have international tax boot camp and there are other things going on at the law school on Saturday, that we had said that Thursday might work better. I'm very happy that we were able to manage to do that. So thank you for coming. Today's session, in fact, I was looking forward to it because it's uh, it's a topic that's close to my heart. Conceptually, it's very enriching and we're quite nuanced, and so I'm actually looking forward to engaging with you on this topic. You'll have to just work with me a little bit today about uh, about coordinating and syncing what I'm going to say to you here with the slides. I think I'll have to use the slides that are in my email, because the PowerPoint part of the presentation is not working very well. Hopefully, we should be able to manage. Just let me know if you get into any trouble there. As usual, I will request all of you to also have your course materials with you, because those course materials are important for you to work along with me whenever I'm asking you to think about something. Yeah, so that's important. Please have your course materials ready as well, because only when you work with me on that we'll be able to understand what's going on. Okay, so with that preliminary, let me start off. Today we're going to talk about an entirely different head, which is capital gains. Head of income. As we said before, we have been talking about different heads of income: salary, and income from house property, business income. And then when it came to business income, we had a comprehensive session on not just what is business income, but also the difference between capital receipts and or business receipts and revenue receipts, as well as the difference between capital expenditure and revenue expenditure. And we took the class through a number of really important case law on this point. And I think we had a great discussion in that case law about how there are so many ambiguities when we try to figure out what the differences between capital expenditure and revenue expenditure and capital receipts and revenue receipts are. Today, we are going to an entirely different head of income. And what we're going to talk about there is what are the conditions under which someone will be taxed when they sell or otherwise dispose of their assets, right? So that's the kind of layman's understanding of what happens when there is, what are the tax consequences when somebody sells or otherwise disposes of their assets, right? That's a question that we're asking here, right? As usual, in answering that question, we have to look at what is the charging section. And once we know what's the charging section, then we start looking into how to apply that charging section to the facts before us. So let's look at the charging section, right? Let's start with that. The charging section, I want you to take a look at it either online or if you have the Bear Act with you, is section 45. And let's just see section 45 says. Let's give it a second. I'm going to pull out section 45 for you and just going to place that below. Okay. So I'm looking at section 45, which is the charging section for capital gains. Okay. And section 45 says, in a very interesting way, that capital gains, any profits or gains arising from the transfer of a capital asset, any profit or gains arising from the transfer of a capital asset effected in the previous year shall, save as otherwise provided in sections 54, 54B, 54D, 54E, 54EA, EB, 54F, 54G, and 54H. In other words, the alphabet soup of 54 sections, section 54 and the rest of it, be chargeable to income tax under the head capital gains and shall be deemed to be the income of the previous year in which the transfer took place. Friends, just look at this section carefully now, right? What do we understand from this section? What are the things that strike us as important and salutary when we look at this section? First of all, it says any profits or gains arising from the transfer of a capital asset. Not any transfer of a capital asset. It's any profit or gains arising from the transfer of a capital asset. It's important for us to notice that because it's not just a transfer that's being taxed. It's a gain from the transfer that's being taxed. In other words, if you transfer an asset, they will logically look at what you sold it for, and then they'll deduct from that what it cost you. And only that gain will be taxed. It's a gain that's important for capital gains tax, not just a transfer. Second thing we understand from this section is it's not profit or gains from something that's happening to a capital asset. It is from the transfer of a capital asset. And transfer is defined in section 2. It says in the definitional section, when you go to the definitional section, it says transfer means, and it's transfer, this is section 2, clause 47. Transfer in relation to a capital asset includes, it's an inclusive definition, includes this, and I'm just going to talk about the first two, 1 and 2. The rest we can talk about later. These are the most important. Transfer in relation to a capital asset includes the sale, exchange, or relinquishment of the asset, or the extinguishment of any rights therein. Okay, come back to section 45. We say it's any profits or gains arising from a transfer. And now we understand transfer as sale, exchange, relinquishment, extinguishment of any rights in an asset, of not just anything, of a capital asset, not just an asset, of a capital asset. What's the capital asset? You go back to section 2 and you see what a capital asset means. And if you go back to section 2, you notice that in section 2, clause 14, 1(4), capital asset means property of any kind held by an SSC, whether or not connected with his business or profession. Property, so it's a wide definition. Property of any kind held by an SSC, whether or not connected with his business or profession. And then there are several other items that are enumerated. We don't have to worry about those items right now, but I just want to gather your attention and pay attention to the fact that the definition itself says it does not include, in clause C, it does not include, after clause C, sorry, but it does not include any stock in trade, consumable stores or raw materials. So these are things that are used in business. So they will go into business income. They won't come under the head capital gains. And it does not include personal effects. That is to say, movable property, including wearing apparel and furniture held for personal use by the assessee or any member of his family dependent on him, but excludes, and there are various things that are excluded. Most important, they want jewelry. So jewelry is taxed. If you have jewelry and you sell it, it will be taxed. Yeah, but otherwise, personal effects are not taxed. Yeah, you can see afterwards, agricultural land is also generally not taxed under this because they're not considered as capital asset at all. Come back to section 45, the charging section. It says, any profit or gains arising from the transfer of a capital asset effected in the previous year shall, as otherwise provided in sections. So, as otherwise provided, in other words, 54, 54B and F and all of those are exceptions to this. 54 and other sections capture transactions that will not be considered as capital gains for purposes of the capital gains head. So that's why it's mentioned, save as otherwise provided. In this, shall be chargeable to income tax under the head capital gains. And then there's an extra phrase there which says, and shall be deemed to be the income of the previous year in which the transfer took place. Not only will it be chargeable to income tax, but also shall be deemed to be the income of the previous year in which the transfer took place. Any reason why that extra phrase is used where it says shall be deemed to be income. Anyone wants to speculate why that's the case? You can either write it on the chat box or raise your hand, and I'll call on you. Just speculate. Why is it that there's an add-on phrase there in the section 45 that says, and shall be deemed to be income of the previous year in which the transfer took place? Any speculation as to why that might be the case, my friends? Yeah. Anyone? I mean, you can. I don't expect you to know it off the top of your head, but well, I suppose we have kind of referred to it once, so it's not. It's something that you might have heard from me before. So it's not something completely unknown to you, I think. But I mean, it's an interesting point, right? Why should they do it? Yeah. Let's see what Dutt is saying. Judicial precedent once excluded the capital gains from the definition of income on account of capital doesn't account for income. No, actually, on the contrary, judicial precedent said that capital gains, the idea of income can encompass capital gains. So you got your, your all those cases, Bhagwan Das case on property income, and Mafatlal case on capital gains. So there are cases that have actually said that. But you're on the right track, which is that the legislature just wants to make it absolutely crystal clear that even though it's capital gains and therefore dealing with capital receipts, it's a kind of a capital receipt. Right? It should still be considered as income, so that no taxpayers are ever able to say, no, this is not income at all. Right? And in fact, to make it even more clear, they have amended the definition of income in Section 2, Clause 24. If you go back to your definition section, Section 2, Clause 24, Clause 6 says that income includes any capital gains chargeable under Section 45. So they've just made it absolutely crystal clear that whatever you might think of about capital receipts, certainly any capital receipt that comes within the definition of capital gains will be considered as income for income tax purposes, will be deemed to be income for income tax purposes. Great. So I hope everybody has understood that so far. I'm just giving you an introduction to Section 45, not doing anything else right now. Just taking you through what the provisions of Section 45 are before we get into the nitty-gritty. Right now, I'm going to try once more to see if I can do something about my other computer, which is still facing some issues. It looks like I can't do anything about it, only because it might be easier for me to show you the slides. If not, we'll have to improvise, which is okay, but not ideal. Right? Okay, let's try this. Okay, we'll improvise. All right, and let's hope it works. And let me know if it's not working. First of all, I'm just going to share my slides with you, and we'll see if it works. Okay, and what I'm going to do now is I'm just going to go into my email and see if I can capture the PowerPoint slides through that email, and just let me know if that's working out for you, right? So can everybody see this? Can everybody see problem 1 on the email, or can somebody just put that on the chat box so that I know that you're able to see that? All right, let's see. Okay, great. So you are able to see it. Lovely. Okay, great. All right, so we'll just improvise it through this. Sorry for that. The best way to get into the nitty-gritty of the capital gains head and discussions under that is actually to make you work through a problem, right? So I've given you a problem here. Just take a look at this problem, and um, I will give you um, I'll give you, say, now it's, yeah, I'll give you until 7:35. So 10 minutes. Yeah. And don't Google, don't do anything. Just tell me how you will address this case. Just on the basis of what I've given you so far. That's all. On the basis of the discussion that we have had in the last 15 minutes, how will you solve this problem? Right? I'll come back at 7:35. Don't Google, don't look at anything. Only on the basis of the discussion the last 15 minutes. How are you going to solve this problem? Yeah? Let's see how you do it. I'll be back. Yeah. Sorry, I'm just trying to toggle my systems. Can somebody just tell me if they're still able to see the screen so that I don't want people to miss out. So can you just tell me if you're able to see the screen, please? Just someone can write on the chat box. Great, thank you. Okay, so I'm back, and let's see what people are up to. Yeah, it could be that some of you have already um, found what the answer is. Let's see. Okay, so I'm just going to read out the answers and see if they work here. So Vivek has said that, as per my opinion, there should be no tax. Well, before we do that, I think just for everybody's sake, let's first uh, read out the problem. Eat Well Industries Limited is in the food processing industry and supplies processed food to airlines. The E12 factory suffered some damages in a major fire incident, and the machinery belonging to E12 was damaged to the extent that it was no longer useful as a machinery and had only scrap value. Since the machinery was insured, E12 received a sum of money from the insurance company. The revenue wants to impose a tax under the capital gains provisions on the difference between the amount of money received under the insurance contract and the original cost of the machinery in E12's hands. Decide this case assuming that the current tax provisions do not contain any reference to money received under insurance contracts. And I've said that the last sentence is because there's been some amendments in section 45, but we're not interested in that so far. What we're interested in now is under this kind of general conceptual idea of transfer, how does it work? And then let me see what people have said. Vivek is saying, as per my opinion, there should be no tax imposed on the amount which was received from insurance company because Eatwell Industry has already paid the insurance premium, its revenue, expenses. Well, Vivek, here we are talking about what's been received. It's not an expense in the hands of Eatwell. Eatwell has received some money. Of course, it has paid premiums in the past, but it has now. What we're not talking about those premiums. We are talking about what has it received under the insurance contract, and that is a sum of money, and we're trying to figure out if that sum of money can lead to income tax or not. So Indu has said there is no transfer here. The asset was destroyed and there was no buyer. Hence, no capital gain should be applicable. That's interesting, Indu, the way you put it. It is quite interesting to me because you're saying that there's no transfer here because the asset was destroyed. So if the asset is destroyed, that means there can't be any transfer. Is that how you put it, Indu? Is that how you want to say it? But I'm not sure that the answer to that question is very clear, right? So the way you worded your response, you said that there's no transfer because the asset was destroyed. And I think what you're trying to say, and correct me if I'm wrong, I think what you're trying to say is that if in a potential capital gain situation, if the asset that's the subject matter of that gain itself is destroyed, conceptually there cannot be any capital gain. I think that's what you're trying to say. Well, I don't know, because I think the answer to that question should be in section 2 clause 47, right? Section 2 clause 47, which defines transfer, and the definition says transfer means, section 2 clause 47, transfer means the sale, exchange, or relinquishment of the asset, or the extinguishment of any rights therein. Well, E12's asset has been destroyed. No, it is extinguished. All the rights of E12 in its asset has been extinguished because of the fire, and it has received some money. Right? So I'm not sure that the connection you're making, Indu, between transfer and destruction of an asset will bear the burden of the way in which transfer has been defined in Section 2, Clause 47. We'll move on. Dignesh, is that correct? Or Dirgesh has said that it should not be taxed as there is no transfer of asset. It's a compensation for the machine which was insured, and there was no capital gain arising. Very good point. Indu made a very good point as well, and you're also making a very good point, Dirgesh, because what you're saying here is that this is not a capital gain situation at all, or a transfer situation at all, because it's a situation where the money is coming out of a contract. There's an insurance contract. It says if there's a fire, something is destroyed, you'll get money. It's that. It's just there's no transfer. The money is not coming on account of a transfer. The money is coming on account of an insurance contract payout, right? And that's why there should not be any capital gains. Dutt has said two questions. Is there a transfer? Is it a capital asset? A transfer of an asset may mean the asset must exist after title changes. If so, there's no transfer because no asset exists, much like the argument that Indu was going towards. And if, however, extinguishment includes the transfer of a destroyed asset, then there is a transfer. And that's what we're trying to figure out here. And if there's a transfer, yes, the machinery is a capital asset. I think that's very clear. The machinery is a capital asset. And so that's where we are, right? So this is a very interesting case, and I'm going to go back to my slides now, and I'll show you what this case is all about. This is a case. Oh, sorry. This is a case. I hope everybody is able to see this. I'm just going to see if I can increase the. But yeah, and if. Let me know if you have any problems. Otherwise, I'll just read out what's happening here. The issue was, this is the famous Vanya Silk Mills case. It's a Supreme Court decision. And in this case, the issue was whether receiving insurance compensation for a destroyed asset constitutes a transfer of that asset under the Income Tax Act of 1961, triggering capital gains tax. And the facts were that this case concerned the taxability of insurance proceeds received for machinery destroyed by fire. And as we know, we looked at the definition of transfer, and it says the court interpreted the inclusive definition of transfer in Section 2, Clause 47, which includes extinguishment of any rights therein, to be, and this is the important point, to be limited to the extinguishment of rights on account of a transfer of the asset. So the Supreme Court said, much like the instincts, much like Indu and Dutt have been talking about, it does not apply to the extinguishment of rights due to the destruction of the asset. The court used the principle of nocitur sauces, which is a Latin principle of interpretation, to interpret the phrase extinguishment of any rights therein, stating that it takes its meaning from associated words like sale, exchange, etc. And in the sale and exchange of assets, the asset survives the transfer, right? And here the asset does not survive the transfer at all, right? So the court disagreed with the High Court's view that any extinguishment of right, regardless of whether it involves a transfer, attracts Section 45. It specifically stated that the High Court had misdirected itself by focusing on the extinguishment of right rather than the idea or the concept of transfer. Okay? So it basically, the ratio in this case kind of dovetails with what Indu and Dutt were already indicating in their messages. Before I move forward, is there any follow-up question or any comment or any doubt that any of you have? Then it will be useful for us to think about it now, right? Okay, great. Let's move on, right? So then we have another case, and again, I'm just going to ask you to look at this case. Actually, in this case, let me read out the problem for you first and maybe help you out a little bit, and then ask you to engage in some speculation, right? And again, we'll work through it together. Right? So in this case, the Karnataka High Court sanctioned a scheme of arrangement whereby Symbiotic Private Limited, the amalgamating company, was amalgamated with Arcadia Private Limited, the amalgamated company. Under the scheme, all the assets and liabilities of the amalgamating company were transferred to the amalgamated company in consideration of the amalgamated company issuing to the members of the amalgamating company 2 equity shares of ₹100 each, creditors fully paid up in the amalgamated company for each equity share held in the amalgamating company. Mr. Gupta, the owner of 1 share in Symbiotic, received 2 equity shares of Arcadia. After 1 year, Mr. Gupta sold his shares in Arcadia to Mr. Singh for a certain sum. What are the tax consequences on Mr. Gupta receiving Arcadia shares in the amalgamation? And then with regard to the Arcadia shares sold by Mr. Gupta, what is the cost of the Arcadia share in Mr. Gupta's hands? Now, maybe I should help you out a little bit. We're talking about, let's, even before we address this problem, let's look at a few things, right? And I think then we can probably figure out how to address this issue. Right? What have we learned so far about capital gains? What we have learned so far about capital gains, and in fact, let me just go back to my screen so that I'm able to see, you're able to see me and hear me out, right? Give me a second. Yeah. Okay. What have we learned so far in this course, right? What we've learned so far is that in the capital gains area, there is a section that says that any transfer of a capital asset results in capital gain, and we have tried to understand some of the complications that result in the idea of a transfer. Transfer means sale and other kinds of disposal, extinguishment, relinquishment, etc. of assets, but it looks like you can't have a disposal or transfer of an asset where the asset is destroyed as a result of the transfer or during the transfer. With that conceptual understanding we have got. But we still haven't got an entire picture of how capital gains works, right? And we said we looked at Section 45, and Section 45 is a charging section. But I've told you already that Section 45 is not just about transfer, it's about gains on account of transfer, right? And we have understood some conceptual problems with transfer. And this idea of gains on account of transfer is cashed out in Section 48. I want all of you to take a look at Section 48, please. And Section 48 says that the income chargeable under the head capital gains shall be computed by deducting from the full value of the consideration received or accrued as a result of the transfer of the capital asset the following amounts, namely, and then it gives you 2 things: expenditure incurred wholly or exclusively in connection with such transfer, any expenditure in connection with the transfer. And then this is the most important thing: the cost of acquisition of the asset and the cost of any improvement thereto, right? So in layman's terms, what Section 48 does is it tells you that in understanding capital gains, what we are trying to look at is what's the gain on capital gains, and that gain is represented by a figure that takes into account how much you got for the asset, how much you paid for the asset, and therefore what it does is it deducts from what you got for the asset, what you paid for the asset. It deducts from your consideration, your cost of the asset, and then arrives at a net amount, and that is the amount that will be subject to the capital gains tax, right? So far, so good. That's section 45. This is section 48. I've also said that when you go back to section 45, you notice that there are some exemptions in section 45 itself, which is this alphabet soup from 54 onwards, 54, 54B, 54D, E, F, etc., etc. In addition to that, there are certain exceptions which are given in section 47. Section 47 says transactions not regarded as transfer, right? And in those, these are the transactions, and section 47 begins by saying nothing contained in section 45 Nothing contained in section 45 shall apply to the following transfers, right? By the way, friends, take a close look at what I'm doing here, right? I've given you section 45, I've given you section 48. Section 45 is the charging section, section 48 is the computation section. And then when you come to section 47, which is a section that talks about transactions not regarded as transfer, you notice it begins by saying nothing contained in section 45 shall apply to the following transfers, right? And there's a slight contradiction between what the heading is saying, which is transactions not considered as transfers at all, and the opening line of section 47, which says nothing contained in section 45 shall apply to the following transfers. So it's already assuming here that they might be transfers for purposes of section 2 clause 47, but they shall not, the capital gains head, the capital gains section, charging section, will not apply to such transfers, which is not the way the heading is describing section 47. And as we know, for purposes of statutory interpretation, it is not the heading that is determinative, it's what is actually said in the section itself. So section 47 is determinative, and we shall therefore say nothing contained in section 45 shall apply to the following transfers, right? So something might be a transfer, but section 47 will not apply. And what does it not apply to? It does not apply to various things. Clause 3, and I'm not going to go through every one of them, but I'll give you some inkling of what it doesn't apply to. It doesn't apply to a transfer of a capital asset under a gift or a will. So if you gift an asset to somebody, or if something goes to somebody under a will, then that will not be covered under section 47. And then it says under clause 6, any transfer in a scheme of amalgamation of a capital asset by the amalgamating company to the amalgamated company, if the amalgamated company is an Indian company. And clause 6A, which says that any transfer in a scheme of amalgamation of a capital asset being a share or shares held in an Indian company by the amalgamating foreign company to the this is amalgamating foreign company. We'll come to amalgamating foreign company in a little bit. We don't have to worry about it now. In the meantime, we'll go to clause 7, which is later on, section 47, clause 7. Clause 7, please. Section 47, clause 7, which says any transfer by a shareholder in a scheme of amalgamation of a capital asset being a share or shares held by him in the amalgamating company, if the transfer is made in consideration of the allotment to him of any share or shares in the amalgamated company, except where the shareholder itself is the amalgamated company, you don't have to worry about that, and the amalgamated company is an Indian company. And what these two are doing, that is section 47, clause 6, and section 47, clause 7, what they're doing is they're talking about taxation of M&As, mergers and acquisitions. And where there are two companies, A and B, A is an amalgamating company, A and B is an amalgamated company, and A merges into B. B survives, A merges into B, and then all the tax consequences regarding that. And the definition of amalgamation, you have to go back to 2 clause 47. And 2 clause 47 says that 2 clause, sorry, not 2 clause 47, 2 clause 1b in the definition section. In the definition section of the Income Tax Act, 2 clause 1b says it gives you a definition, and it says amalgamation in relation to companies means the merger of one or more companies with another company, or the merger of two or more companies to form one company. The company or companies which so merge being referred to as the amalgamating company, and the company which they merge is the amalgamated company, in such a manner that all the property of the amalgamating company or companies immediately before the amalgamation becomes the property of the amalgamated company by virtue of the amalgamation. All the liabilities of the amalgamating company or companies immediately before the amalgamation become the liabilities of the amalgamated company by virtue of the amalgamation. Shareholders holding not less than 3/4 in value of the shares in the amalgamating company or companies before the amalgamation become shareholders of the amalgamated company by virtue of the amalgamation. And that's how amalgamation is defined. Friends, we are going to do something very different from what we have been doing in the previous classes. I'm going to ask you to work through some issues now, and I'm going to ask you to sink your teeth into the legislative provisions that are in front of you, right? And then I'm going to kind of make you learn why we are so interested in this area of M&A and taxation and capital gains, right? So this is what I'm going to ask you to do. Please listen to me carefully. This is important. You'll have to do a little bit of work for me, but I'm sure you'll come out well at the end of it. I've given you a certain few sections to look at. Section 45, Section 48, Section 47, and in Section 47, I've asked you, please make a note. I've asked you to take a look at Section 47, and I've told you take a look at Section 47, Clause 6, and Section 47, Clause 7. And then I have asked you to take a look at the definition of amalgamation in Section 2, Clause 1b. Right? I'm assuming, because this is important for me and for you, that you have access to these sections either online or in front of you in hard copy. Now, what I'm asking you to do is I'm going to ask you to apply these sections, just these sections that I've asked you to do, to a set of facts that I'm going to give you, and tell me what you make of it. Right? Now, when you do that, there is one part of the facts where some other section is involved, which I've not stated so far, but I'll do that for you when I discuss the answers with you. This is not meant as an exam, it's meant as a learning process. So I want you to not Google, not look at anything, just focus on the sections I've asked you to focus on. And then use those sections to see what you can come up with as an answer to what I'm going to give you now. Yeah. So I'm going to go back to sharing. And I'm going to give you a set of facts. This is what I want you to take a look at. Okay. I'm going to give you 10 minutes as usual. Don't worry about anything other than what I've just now told you in the last 20 minutes. Yeah. And just take a look at only that and apply it here and see what you can come up with. Yeah. That's the only way we'll learn it together. Right? Otherwise, it'll become too tedious for us. Yeah. Okay. I'm going to come back in 10 minutes time. Okay, who's going to help me? Indu has said that as per Section 47, Clause 7, any transfer of shares at the time of amalgamation is not regarded as transfer, but after holding it for a period of 1 year, and when Gupta sells, there will be a capital gains applicable. Okay, all right. That's correct. But let's just step back a bit. Let's just step back. Let's do this in a more systematic fashion. Yeah. Okay. Let's see. Just give me a second. So, one second. Um, okay. I'm just going to, because I want to help all of you understand this better, I'm just going to stop sharing and come back to my class. Let me first understand from you. We have plenty of time, by the way, so don't worry. And I'm going to give you a small break. I know that you've been working nonstop, and we haven't had a break yet. But don't worry about that. I'll give you a small break. But before that, let me ask you this. Let's do it systematically, right? We discussed Section 45. We discussed Section 48, 47. We discussed various definitional sections in the Income Tax Act. But we should start from the basics if we want to understand why we are jumping into amalgamation. Right? So let's do that first, and let's see how we understand this. First of all, let's understand this from the point of view of the simplest form of amalgamation, simplest, which we don't need any diagrams, we don't need any paintings to understand. We can just do it by just talking to each other, right? So we say there's a company A, there's a company B, right? B merges into A such that A remains and B disappears. First question for you. Why would that happen in the first place? Commercially, forget about tax. Right? Commercial. Why is that? Why would that happen? Why would company B merge into company A? Let's talk about that a bit. Anyone? Yeah. And remember, you can chat, you can talk, you can raise your hand. So you can do all of that. So tell me, why would two companies merge, right? I mean, let's grasp it. Let's do it slowly. There's no hurry. We can come to tax in a bit, but let's first figure this out. Why would company B merge into company A? And Indu is saying expand business, which is a good answer. Increase the going concern's profitability. That's right. So it could be that A and B are in the same business. Let's say that they manufacture refrigerators, and they think that by pooling the resources together, economies of scale, that is saying going concerns profitability, Hindu is saying expand business. They're able to do that, and therefore merger makes business sense, right? I'm going to use the words merger and amalgamations interchangeably. So amalgamation of B into A makes sense. Okay. In an amalgamation, what happens is there are two kinds of transfers, potential transfers happening. Right? One at the company level and the other at the shareholder level. So listen to me carefully, because this is important. In any merger or amalgamation situation, there are two potential transfers or potential capital gain triggering events happen. Right? One is because when B merges into A, the assets of B, which may be valuable, um, are going to A. So there's a potential capital gain there. Company B holds certain assets, and those assets are now leaving Company B and going to another person, and so there may be a potential there's some transfer of assets, right? I don't know. I'm using transfer in a very loose sense, but there's some transfer of assets and of valuable assets. The second potential capital gain situation, trigger point, is at the shareholder level, because in the same amalgamation, Company B's shareholders are exchanging their shares in B for A. So they all will become A's shareholders, right? As you said, the way, even for an amalgamation to qualify as an amalgamation under the Income Tax Act, it has to fulfill the definition of Section 2, Clause 1, Clause B, which has the following conditions. An amalgamation is an amalgamation for purposes of the Income Tax Act if all the assets of Company B are going to Company A, all the liabilities of Company B are going to Company A, and 3/4 in value of the shareholders of Company B will become shareholders in Company A. And I'm assuming in the facts I'm giving you, all these three conditions are fulfilled. If so, we have a potential capital gains problem at two levels. At the level of the shareholder, because it could be that Company A shares are very valuable, and so the shareholders in Company B are getting a very valuable Company A shares in return for their shares in Company B. And could be that Company B's assets are valuable and they are now going off to Company A, and there's some potential capital gains transaction there. Now, both of these potential capital gain transactions are being exempted by Section 47, because Section 47 is saying in Clause 6 that any transfer in a scheme of amalgamation of a capital asset by the amalgamating company to the amalgamated company, if the amalgamated company is an Indian company, then that transfer of a capital asset is exempted. There's no capital gains tax at the company level. And there's no capital gains tax at the shareholder level as well, because of Section 47, Clause 7, which says that any transfer by a shareholder in a scheme of amalgamation of a capital asset being a share or shares held by him in the amalgamating company, if the transfer is made in consideration of the allotment to him of any share or shares in the amalgamated company, and the amalgamated company is an Indian company, right? So so far so good, right? This is the two trigger points, and both of these trigger points are met by the exemptions in Section 47, one in Section 47, Clause 6, and the other in Section 47, Clause 7, right? Now we'll come back to the facts. We'll see where we are. Okay. Now we go back and we see that I'm sharing the screen with you. It says the Karnataka High Court sanctioned the scheme of arrangement. Remember, all mergers and acquisitions that will have to be sanctioned by the court. In this case, I've said Karnataka High Court, but now it's NCLT after the amendment. So the NCLT is the one that sanctions scheme of arrangements. And you notice that under the scheme, all the assets and liabilities of the amalgamating company, which is Symbiotic, are now transferred to Arcadia, and therefore there won't be any capital gains tax there. And then Mr. Gupta, the owner of one share in Symbiotic, received two equity shares of Arcadia. And again, there potentially there's no tax because of the exemption under Section 47 and after 47 Clause 7. And after 1 year, Mr. Gupta sold his shares in Arcadia to Mr. Singh for a certain sum. And the question is asking you, What are the tax consequences on Mr. Gupta receiving Arcadia shares in the amalgamation? And your answer would be, you know, nothing because of section. What are the tax consequences on Mr. Gupta receiving Arcadia shares? Well, nothing because um, section 47 clause 7 applies. The next question, it says, with regard to the Arcadia shares sold by Mr. Gupta, what is the cost of the Arcadia shares in Mr. Gupta's hands? That is slightly more complicated. And I think you deserve a break. So I'm going to give you a small break. Uh, when I come back, we'll discuss that part of the question. In the I'm just thinking that I'm just trying to see how much we need to cover today. And I think that we have we have one more thing that I want you to cover properly here. So maybe I should not give you a very long break. I'll give you a 5 minute. I'll give you 8:30. We'll be back at 8:30, and at 8:30 we'll talk about the rest of the question. Yeah. Um, because I want you to, I'm going to discuss a case that addresses these facts. And there's one complication in the case that I particularly want you to take a look at. So hold your horses. We'll just do that and then we'll come back. Yeah, so I'll see you at 8:30. That's a break for you. You don't have to do anything much. When you come back with fresh minds, I'm going to talk to you a little bit more about this case. Thank you. Okay, so I'm back. We have half an hour, and I want to. I know that we are, it's late in the day, so attention spans may be lagging. But I want to make sure that we are all on the same page in a subject that's some people may think of as slightly um, complex, right? So we talked about amalgamations, and you said potential capital gain issues in amalgamations and how the transfer provisions take care of it, right? And we had said that um, there's a Arcadia symbiotic, and there's an amalgamation, and um, and both shares are being exchanged, and then there are some assets going as well. Um, Indu and Dutt have been telling me about how amalgamations are important. But one thing that we haven't really talked about clearly is that why do we need something like Section 47? Because Section 47 is an exemption section. And one might say that we need exemptions because we want to encourage amalgamations and mergers. And if you ask why do you want to encourage mergers and amalgamations, good for business. In any case, when company B merges into company A, and all of the shareholders of company, or three-fourths of the shareholders of company B at least get to be owners in company A, then they're really owning property through some other corporate entity, and therefore that kind of ownership should not result in any capital gains tax. So there's various reasons why we might say capital gains would like to the capital gains provision should be exempted for mergers and amalgamations. In this course, which is an introductory course to tax, why are we talking about taxation of mergers and amalgamations? Because mergers and amalgamations is a major important area of corporate activity. And it might well be the case that anyone dealing with the tax aspects of corporate law will end up talking about taxation of mergers and acquisitions at some point of time. So that's why we are focusing on it in so much detail, right? Now, let's go back to the problem, and I want to talk about the last part of it, right? So here we said, well, after Mr. Gupta, the owner of one share in Symbiotic, received two equity shares of Arcadia. We said Section 47, Clause 7, he will not get any tax. He will not be taxed under capital gains. But after 1 year, Mr. Gupta sold his shares in Arcadia to Mr. Singh for a certain sum. And here my question was, with regard to the Arcadia shares sold by Mr. Gupta, what is the cost of the Arcadia shares in Mr. Gupta's hands? Now, this is important for us because um, in order for us to understand how capital gains works, we need two metrics. We have already talked about that. The two metrics we need are mentioned in Section 48, which are the consideration received for the asset. What's the assets? What did you sell the asset for? The amount of money you sold the asset for. And the second metric is what is the cost of the acquisition of the asset. The second metric in an amalgamation situation is difficult to determine, right? Because when I ask you, what's the cost of Arcadia shares in Mr. Gupta's hands? Well, Mr. Gupta never bought Arcadia shares. He had symbiotic shares with him. And in a amalgamation situation, he received Arcadia shares. But he never bought them. He never spent any money on Arcadia shares. And how do you therefore determine the cost in Mr. Gupta's hands of Arcadia shares? That's a question. And the answer to that question, my friends, again, I'll have to request you to go back to the Act. The answer to that question is in the Act itself. And if you go to Section 49, Section 49 says, cost with reference to certain modes of acquisition And it mentions 49 clause 1 mentions where the capital asset becomes a property of the assessee, and then it tells you a lot of things under a gift or a will or by succession or inheritance or devolution, etc. And then it says, if you scroll down, in clause 2, 49 clause 2, where the capital asset being a share or shares in an amalgamated company, which is an Indian company, becomes a property of the assessee in consideration of a transfer referred to in clause 7 of section 47, the cost of acquisition of the asset shall be deemed, please listen to this carefully, the cost of the acquisition of the asset shall be deemed to be the cost of acquisition to him of the share or shares in the amalgamating company. And therefore, in this case, the cost of acquisition of the asset shall be deemed for, in our case, for Mr. Gupta, with respect to the Arcadia shares, the cost in the Arcadia shares shall be deemed to be the cost in Mr. Gupta's hands of the symbiotic shares. In other words, the cost in Arcadia shares will be whatever he paid for acquiring the symbiotic company shares. Right? And that's the effect of 49 clause 2. If 49 clause 2 are not there, it'll be impossible to figure out what the cost of Arcadia shares would be in Mr. Gupta's hands. Yeah. I'm just going to stop here 1 second, and I'm going to ask if anybody had a question or a comment or a doubt. Okay, so then we'll go back and we'll discuss the case, which is based on these facts, which is the Commissioner of Income Tax Cochin versus Grace College. It's a very important case. And it concerns the assessment of capital gains tax on shareholders following a company amalgamation of the sort that you just saw in the facts above. Whether a share exchange in an amalgamation constitutes a transfer under the Income Tax Act impacting capital gains calculations, the central issue revolved around the interpretation of transfer in Section 45. And the court ultimately reversed the High Court's decision, finding that the transfer had occurred and that the capital gains tax should be calculated accordingly. And the court disagreed with the approach taken in Vanya Silk Mills. And I'm going to ask you, or I'm going to tell you a little bit more about what this case is about. If you just go back to the facts here. In this case, and I want you to listen to this very carefully, because you might find the discussion slightly difficult to follow. In this case, the argument of the taxpayer, Mr. Gupta, was that when the amalgamation took place and he, in exchange for his symbiotic shares, he received Arcadia shares, there was no transfer at all, because following the logic of Anya Silk Mills, that asset that was transferred, namely symbiotic, was destroyed. Right? The symbiotic shares just went out of existence, and he got Arcadia shares in return. So he got something valuable in return for symbiotic shares. And of course, his rights in the symbiotic shares were extinguished, and therefore there was a technical transfer. But Vanya Silk Mills says if the asset which is transferred itself is destroyed, there's no transfer at all. So Mr. Singh's argument was that, look here, in this case, in an amalgamation situation, there cannot be, even conceptually, following the Vanya Silk Mills definition, there cannot be any transfer at all. There is no transfer, because symbiotic shares are destroyed. They go out of existence, right? And if there is no transfer, then that's the case. There is no transfer at all. Now, my friends, this is one of the situations in which I want you now. I know it's close to 9 o'clock Thursday night. You are all tired, but I want to prick your brains a bit, right? And I want to ask you this question: why is the taxpayer making this argument? Who cares? Anyway, the transfer is exempt. Anyway, when he exchanges his shares, it's exempt under Section 47, Clause 7. Correct? As Indu pointed out. So then why is he worried about whether it's a transfer or not? Anyway, the transfer is exempted under Section 47. Right? Anyway, when you exchange your share in amalgamation in your company for other company shares, that transaction is exempted, is capital gains free. Why is he then insisting on this conceptual point that there's no transfer at all? Why? That's a question I'm asking. Let us see if anyone can answer that question for me. All right, people are curiously typing, but let us see. Well, Indu has asked a question: if it's a private limited company which is getting amalgamated, how will the cost be asset? Well, I mean, there'll be some accountant who will take into account the net asset value or the future cash flow of the company and assess the value. Vivek is asking, what's the cost of Arcadia share? As I said, Section 49 now says it's the cost of the symbiotic share. Dutt is saying he likely wants a bump up to the fair market value of his shares cost. That way, fair market value on sale equals his bump up cost. Therefore, capital gain equals 0. Yeah, but I don't think he's playing for something else, Dutt. I don't think that's what he's doing. I'm being a bit unfair to all of you, by the way, because there's some concept here that we haven't yet. Well, we've kind of talked about it again in the previous classes, but not in the way that's explicit, right? So let's see if anybody can get this. So you need to really think through this. I'll repeat this question for you. I'm going to repeat it for you, right? So please pay careful attention to me. Here's the question. Why is the taxpayer insisting, and I'm going to go back to the facts. Why is the taxpayer insisting in Commission of Income Tax versus Grace College that forget about Section 47, Clause 7. This is not a transfer at all for purposes of Section 45. Why is the taxpayer insisting? That's a question, right? I'm going to give you one last chance if somebody has something to say. Yeah, too late in the night. Brain's not working. All right, here's an answer for you. The reason why the taxpayer is saying, and as I said before, maybe I'm a bit unfair to you because we haven't explained this concept in detail earlier. But maybe when I give you the answer now, it may jog your memory. Here's what the taxpayer is trying to do. It's really interesting. What the taxpayer is trying to do is trying to say, look, I don't come under Section 47(7) at all, that exemption at all, because Section 47, Clause 7 requires there to be a transfer in the first place for it to be exempted. If I don't come under Section 47, Clause 7, then I will not come under Section 49, Clause 2 at all. Because Section 49, Clause 2, which says that your cost in your Arcadia shares would be a cost in your symbiotic shares, is dependent, is connected to first this transaction being exempted under Section 47. If Section 49 Clause 2 doesn't apply, then it's impossible to figure out what the cost is of the asset in his hands, cost of Arcadia. Remember, Dutt said that your instincts are right. Dutt is saying, he's trying to increase the Arcadia shares cost in his hands. But the point is, there is no legislative guidance other than Section 49, Clause 2 on how to determine it. What Dutt is saying is maybe some logical way or some other way of dealing with it, but tax law doesn't care. Tax law, if you want to know the cost, you have to figure it out in the Act. The Act has to tell you. Right? And if the Act is silent, if you're not able to figure out the cost, then what happens, and this is a kind of a legacy issue in tax law, is that the calculation itself fails. Section 48 fails. Section 48, which is the calculation section, says you need to know the consideration, you need to know the cost. If you don't know the cost, if you can't figure out what the cost is, then the calculation fails. If the calculation fails, the whole scheduler system of tax here fails. You can't impose a tax. That is what the taxpayers try to get at. Right? There's a famous case which we'll do, not in this session, but in the next session, called the Srinivas Shetty case. And that case says something like this. It says that if we are not able to figure out the cost of an asset for capital gains purposes, we cannot impose a capital gains tax. We can't say, well, logically speaking, this should be the cost, or this, let us understand the cost in a reasonable way. No, tax law doesn't work that way. In tax law, calculation is as important as the rest of it, as a charging section. And therefore, if we are not able to figure out the cost, then we won't be able to figure out the tax at all. So I'll go back to my slide here. So in this slide, what the taxpayer is saying is that the share exchange in the amalgamation does not constitute a transfer. And the court's answer to it was, no, it does constitute a transfer, right? And therefore, Section 47 will apply to exempt it, and therefore, Section 49, Clause 2 will apply, and therefore, we can figure out the cost when you later transfer it to somebody else. But here's the issue. The court disagreed with the approach taken in 1A Silk Mills, because you see, if you just use 1A Silk Mills, you will agree with me. If you just use 1A Silk Mills, you will agree with me that there is no transfer, because when symbiotic shares are transferred, when the symbiotic shares in an amalgamation or exchange for Arcadia shares, symbiotic shares go out of existence. That's the whole idea of amalgamation. The company, symbiotic itself, will go out of existence, and therefore its shares will go out of existence. And so therefore the court had to deal with that, right? And now I'll ask you to go to your course materials and take a look at what the court said. The court disagreed with the approach taken in 1A Silk Mills, and the court said the following. If you go to note 27, please, note 27 on your in your course materials, and second paragraph. Well, actually, let's look at all the three paragraphs because it's fairly important. I'm just going to read this out. Learned counsel for the revenue submitted that having held that the payment and settlement of the insurance claim was not in consideration of the transfer to the insurer of the damaged machinery, and that therefore there was no transfer within the meaning of Section 45, it was unnecessary for this court in the 1A Silk Mills case to go on to consider the definition in Section 2, Clause 47, and the meaning to be attached to the expression extinguishment of any rights therein. That was making the same point earlier. He was focusing on the insurance contract. In his submission, the decision in 1A's case was to that extent obiter dicta. Obiter dicta means it was not relevant to the decision of the case. The definition in Section 2, Clause 47 of transfer included sale and exchange. In each of these cases, there was an extinguishment of the right of the seller or exchanger in the capital asset. To restrict the extinguishment of rights to extinguishment on account of transfer was in learned counsel's submission to render the expression extinguishment of any rights therein otiose, in other words, irrelevant, and to nullify the effect of their use in the definition. And then the Supreme Court goes on to say, well, we have given careful thought to the definition of transfer in Section 2, Clause 47, and to the decision of this court in 1A's case. In our view, the definition clearly contemplates the extinguishment of rights in a capital asset, distinct and independent of such extinguishment consequent upon the transfer thereof. We do not approve respectfully of the limitations of the expression extinguishment of any rights therein to such extinguishment on account of transfers or to the view that the expression extinguishment of any rights therein cannot be extended to mean the extinguishment of rights independent of or otherwise than on account of transfer. To read the expression is to render it ineffective and its use meaningless. As we read it, therefore, the expression does include the extinguishment of rights in a capital asset independent of and otherwise than on account of transfer. This being so, the rights of the assessees in the capital asset, being their shares in the amalgamating company, stood extinguished upon the amalgamation of the amalgamating company with the amalgamated company. There was therefore a transfer of the shares in the amalgamating company within the meaning of Section 2, Clause 47. It was therefore a transaction to which Section 47, Clause 7 applied, and consequently the cost to the assessors of the acquisition of the shares of the amalgamated company had to be determined in accordance with the provisions of Section 49, Clause 2. That is to say, the cost was deemed to be the cost of the acquisition by the assessee of their shares in the amalgamating company. Yeah, so I'm going to stop here and I'm going to ask if people have understood what's going on, or is there any doubt, or do you have any comments? Is there anything that people want to talk about? You can raise your hands, you can. Okay, so then I'm going to stop sharing here and I'm going to request you to then go on and go to your materials, course materials, and go to note just give me a second. I'm trying to get that case for you so that if you go to note 28, it begins with CIT versus BC Srinivas Shetty. Don't worry about that for the time being. Just scroll down and you will go to a case called Nilamalai Agro Industries versus CIT, which is a Madras High Court decision in 2002. Very interesting decision. It's a decision that had similar facts as the Vanya Silk Mills case. This was a case of an asset being destroyed and an insurance payout for the asset. And in this case, the Madras High Court distinguished Grace Collis. So we have a peculiar situation, where you have Vanya Silk Mills case, Supreme Court case, overruled to some extent, we would think, by the Grace Collis case, and then Grace Collis case being distinguished in the Nilamalai Agro Industries versus CIT case. Yeah, and I want you to go and take a look at these notes here with me. We read it out. Nilamalai Agro case, they say, when a thing is destroyed by fire or when a ship sinks into the sea, the capital asset is no longer available for being owned, used, or enjoyed by anyone, including the assessee. With the destruction of the asset, the rights of the assessee in that asset would also be destroyed. The destruction of such rights in an asset consequent upon the asset ceasing to exist is a situation which is not contemplated either in the definition of transfer or in the charging section. Learned Counsel for the Revenue, however, contended that the law declared by the Apex Court, Supreme Court, in the case of Vanya Silk Mills case is no longer good law, and that the decision has been both expressly and impliedly been overruled by a 3-judge bench in the case of Commission of Income Tax versus Grace Collis. In the case of Collis, the court was concerned with the question as to whether there is a transfer of the shares in the amalgamation of the company, whose shares are held by the assessees ordered by the court with another company. The court held that the right of the assessee in the capital asset, that's the shares in the amalgamating company, stood extinguished upon the amalgamation of the amalgamating company with the amalgamated company, and that therefore a transfer of the shares in the amalgamating company within the meaning of Section 2, Clause 47. It was therefore a transaction to which Section 47, Clause 7 applied, and consequently the cost to the assessees of the acquisition of the shares of the amalgamated company had to be determined in accordance with the provisions of Section 49, Clause 2. That is to say, the cost was deemed to be the cost of the acquisition by the assessee on their shares in the amalgamating company. Now the court is saying, Nilamalai Agro, Madras High Court is saying, on the amalgamation of on the amalgamation, just give me 1 second, I just lost my card for a second. On the amalgamation of one company with another, the assets and liabilities of the amalgamating company are taken over by the amalgamated company. Those assets and liabilities do not cease to exist when amalgamation takes place. They continue to exist. The ownership of those assets stand transferred to the amalgamated company. The rights of the shareholder in the shares held by him or her in the amalgamating company which had owned the assets are replaced by the rights given to such shareholders in the shares of the amalgamated company, which takes over the assets and liabilities of the amalgamating company. Shares in the amalgamated company are allotted to the shareholder of the amalgamating company as a consideration for the transfer of the assets of the amalgamating company. Despite the extinguishment of the rights in the shares of the amalgamating company on its dissolution, the assets which give value to those shares prior to amalgamation continue to exist now under the ownership of the amalgamated company and may provide added value to the shares of the company. The extinguishment of rights in the capital assets, in the capital asset referred to in the definition of transfer in Section 2, Clause 47 of the Act, therefore would clearly apply to a case where the rights in the shares in the amalgamating company are extinguished on amalgamation to be replaced by shares in the amalgamated company, which after amalgamation is the owner of the assets transferred to it as a consequence of the amalgamation, and which will therefore have the ownership, use, and benefit of those assets. The case of amalgamation of companies and the extinguishment of rights of the shareholder in the amalgamating company is no way comparable to the destruction of the assets, which as a consequence brings about the extinguishment of the rights of the assessee owner in such cases. In the case of Grace Collis, the court did not have occasion to go into the question whether the destruction of a capital asset, which as a consequence brings about the extinguishment of the rights of the assessee owner in such asset, would amount to the transfer. The court did not hold that Vanya Silk Mills was wrongly decided, or that the definition of transfer, particularly the use of the words extinguishment of any rights there, would cover cases of destruction of the capital asset. Cases such as the destruction of capital asset in a fire or its complete loss, as in the case of sinking of a vessel in the sea, cannot be regarded as having brought within the fold of definition of transfer in Section 2, Clause 47 by reason of what has been said and laid down in the case of Collis. The law laid down in Vanya Silk Mills' case that extinguishment of rights in a capital asset as a necessary consequence of destruction of the asset does not amount to transfer has not been overruled by the apex court in the case of Collis. And friends, we are coming to an end of this discussion here. Next week, we will revisit these cases. Capital gains will be discussed again next week, and I'm going to discuss this case and other cases. And there's a little bit of homework for you. Now, not next week, whenever we meet next. A little bit of homework for you, which is you should tell me whether you're convinced by how Nilamalai Agro distinguished Grace Collis. Yeah, because it looks like they're saying Grace Collis does not apply to this kind of insurance case that we're talking about. You should tell me whether you're convinced by that. Right? That's what we need to ask. Remember, the important point they're making here is that the case of amalgamation of companies and the extinguishment of rights of the shareholder in the amalgamating company is in no way comparable to the destruction of the assets, which as a consequence brings about the extinguishment of the rights of the assessee owner in such assets. And I want you to tell me when we meet next whether you agree with this analysis or not. Until then, goodbye. Thank you so much for coming to this class at a late time in the late evening. Have a great weekend, and we'll discuss these cases. We'll review these cases a little bit when we meet again, and then we'll go forward with that. Thank you, and see you next time. Good night.